Now we're going to turn our attention to diversification and reevaluate diversification from what we've learned so far. We saw that modern portfolio theory argued that the primary benefit of diversifying your portfolio is to mitigate the effect of price volatility of individual stocks. But we've just discovered that Warren Buffett is unconcerned with price volatility. He does not use market price to measure his investment decisions or performance. Buffett argues that portfolio concentration may well decrease risk, providing it forces the investor to think more deeply and better understand the business before he invests in it. It is the economic characteristics of the business on which he focuses, not the daily offer from Mr. Market. Buffett defines his circle of competence, the types of businesses which he can readily understand. So he decides beforehand what sorts of businesses he feels comfortable investing in. Now, in my case, I understand something about some tech businesses, but not something about, very complex software businesses. I don't understand pharmaceutical businesses. I do understand building materials businesses because I worked in that sector for quite a long time. So I know where my circle of competences are, and you have to decide where your circle of competence lies too. So Buffett defines his circle of competence, and then he studies these businesses closely to understand their intrinsic value. The more you know about the company in which you want to take a part ownership, because that's what an investment is, the less risk you are likely to be taking. For Buffett, diversification is simply a protection against ignorance. What he calls the know-nothing investor should simply buy an index tracking fund in the market in which he wishes to invest. And Buffett often recommends the S&P 500 index tracker. He said, look, if you really don't know anything about investing, then just buy the market, because that way you're going to do at least as well or as badly as the market. You may not overperform, but you won't underperform. Such protection, of course, does come with a price. Anyone investing in the index tracker, costs aside, will never do better than the market. And Buffett has no interest in only matching the market. A significant number, however, of modern fund managers, adhering closely to the tenets of modern portfolio theory, still manage to underperform the market as they desperately try to perform quarter to quarter measured by share prices. So now we see that we need a more business-centric approach to valuation and investment. But how does this affect our understanding of the efficient market hypothesis? We'll see that in the next lecture. So we've reevaluated diversification, and actually we're arguing the exact opposite, that actually having hundreds of companies in your portfolio doesn't actually mitigate risk if you don't know anything about those companies. And the only way to make diversification work is to buy the whole market, so buy an index tracker. Otherwise, Buffett would argue, and I would argue, that if you really do your homework and understand a business, you're reducing your risk, and having a few really well understood companies in your portfolio is a much better way of reducing your risk than simply throwing darts at a dartboard.